Welcome to this explainer. Today, we're rolling up our sleeves, putting on our expert analyst hats, and running Intel's 2026 financial reality through a brutal valuation gauntlet. We are going to look at the hard data to see if this highly publicized strategic turnaround is actually investable right now or if it's just a really good story. Let's dive in. Here is our game plan. We'll start with a quick Intel snapshot, view the stock through the classic Buffett, Lynch, and Graham lenses, run some modern DCF and multiple valuations, and then deliver our final verdict. All right, part one, the Intel snapshot. You know, the tension here is absolutely incredible. On one hand, Intel has this powerful, patriotic narrative. They are bringing advanced logic manufacturing back to the US and are heavily backed by government funding. But the million-dollar question for us as analysts is whether that awesome narrative actually justifies its current market valuation. We need to know, is this investable today? Well, the contrast in their financials is kind of mind-blowing. Trading at around $124 a share, giving them a massive market cap of roughly $626 billion, according to DBS Bank data, Intel raked in $13.6 billion in Q1 2026 revenue. Sounds great, right? But here's the catch. The foundry segment alone burned through $2.4 billion in operating losses on $5.4 billion in revenue. And external foundry revenue, a mere $174 million. So we're looking at a massive operation that is currently just hemorrhaging cash.
Moving right along to Section 2, the Buffett lens.
So the big question is, does Intel have the traits Warren Buffett absolutely loves? First up, an economic moat. And yeah, absolutely, they do. They've got a massive barrier to entry backed by a $7.86 billion U.S. CHIPS Act award and decades of process IP. Plus, they passed the debt test with a totally manageable debt-to-equity ratio of 35.8%. But here is where the wheels completely fall off for Buffett. He demands consistent earnings and a high return on equity. Intel suffered a net loss in fiscal 2024, and its current ROE is sitting at a dismal 0.3%. For Buffett, that is a massive, immediate red flag. And it gets worse when we look at owner earnings. If we approximate those using DBS's projected fiscal 2026 free cash flow, we get roughly $2.3 billion. Now, against a $626 billion market cap, that translates to a free cash flow yield of just 0.4%. You know Buffett, he requires a massive margin of safety before making a move. At these prices, Intel just doesn't offer one. He'd be sitting on his hands waiting. Let's pivot over to Section 3. The Peter Lynch lens. Peter Lynch famously categorized stocks to understand how they behave, right? Well, he would definitely categorize Intel as a hybrid. It's an asset play because it is sitting on incredibly valuable underlying assets, like its vast global fab network. But it's also a colossal turnaround story, hinging completely on the success of its new 18A manufacturing node. The good news? The balance sheet is strong enough to survive the turnaround, which Lynch would definitely appreciate. But what about the price tag for that turnaround? Lynch loves the PEG ratio, price to earnings divided by the growth rate. Generally, he wants a PEG of 1.0 or lower. If we take Intel's forward PE of 113.2 and factor in an aggressive 45% profit growth estimate for fiscal 2027 from DBS, we get a PEG ratio of around 2.5. That is way above Lynch's preferred threshold. The market price is already acting like this turnaround is a guaranteed slam dunk. So Lynch would likely rate this a hold and wait to see if external customers actually start buying 18A capacity before paying that kind of premium. Next up, Section 4, the Benjamin Graham lens. Graham wants ultra-safe, deeply undervalued assets. So let's run his checklist. Adequate size? Pass easily. Strong financial condition? Pass. Net debt to equity is near zero. But then, boom, we hit a brick wall. Earning stability? Fail. It's highly volatile with recent losses. Dividend record? Fail. The yield is currently suspended at 0. Moderate multiples? An absolute spectacular fail. Graham wants a PE under 15 and price to book under 1.5. Intel is sitting at a forward PE of 113 and a price to book of 5.6. This next part brilliantly illustrates how totally detached the stock price is from historical value investing metrics. Let's calculate Graham's specific intrinsic value using his legendary formula, the square root of 22.5 times earnings per share times book value per share. To fill in our gaps, we divide the $124.57 price by the 113.2 PE to get an implied forward EPS of $1.10. Then, we calculate book value by dividing the price by the 5.6 price-to-book ratio, giving us $22.24. Okay, we plug that $10 and $22.24 into the formula, and Graham's conservative math spits out an intrinsic fair value of roughly $23.46 per share. Just let that sink in for a second. Compared to the current price of $124.57, this reveals a severely negative margin of safety. Graham wouldn't just avoid this stock, he would rate it a hard, unambiguous sell. All right, moving on to Section 5, DCF and multiple valuations. To build our base case discounted cash flow model, we're using DBS's projected free cash flows, $2.3 billion in FY26, jumping to $6.3 billion in FY27 as the foundry scales up. Now, because the WACC, the weighted average cost of capital, and the terminal growth rate aren't explicitly provided in the source data, we have to assume standard, mature semiconductor industry rates here. So, we're going with a 9% WACC and a conservative 2% perpetual terminal growth rate. When we run a sensitivity table on these assumptions, flexing the WACC between 8 and 10% and terminal growth from 1 to 3%, it gives us an implied fair value anchoring somewhere between $65 and $85 per share. And notice how heavily reliant this valuation is on that massive, hypothetical free cash flow spike in 2027. Even if we give them full credit for that future growth, the DCF still suggests the stock is currently way overvalued. Evaluating this through comparable multiples really paints the market's current optimistic picture. DBS projects an enterprise value to EBITDA ratio of 32.4 times for fiscal 26, and they base their specific 12-month target price of $115 on a 5.1 times forward price-to-book multiple. They actually note that this premium re-rating reflects improved market sentiment and AI demand rather than actual current fundamental cash generation. Finally, Section 6. Synthesis and final verdict. Synthesizing all these methodologies reveals a truly massive gap in valuation. Qualitative, old-school value investors like Graham are demanding a sharp drop, valuing the company under $24 based on hard assets and current earnings. Buffett and Lynch, they demand you wait until that PEG ratio drops or cash flows actually stabilize. Meanwhile, modern multiple-based targets like DBS's $115 target are trying to price in a fully successful government-backed turnaround. So, what should you really take away from all this? It comes down to a balance of strengths and risks. The fundamental strengths are absolutely real. Robust government backing with the CHIPS Act funding and deep process IP with the 18A node. But honestly, those are completely overshadowed right now by the severe risk of negative 45% operating margins in the foundry division, heavy capital expenditures, and a distinct lack of external revenue, which is sitting at just $174 million. Blending all these insights from our guru frameworks, the DCF model, and aligning with the DBS bank rating, our final recommendation for Intel at its current price is a strict hold. The market is basically already pricing in a turnaround that the financial statements simply do not prove yet. So, when do you buy? Well, Graham would ruthlessly hold out for a total market collapse, waiting for the stock to drop below $23. For the rest of us, Buffett and Lynch criteria might trigger a buy closer to the $70 to $80 range, which matches our DCF fair value. But, and this is a huge but, that buy trigger only activates if external foundry revenues actually begin to scale materially, and the company starts generating consistent, positive free cash flow. We will leave you with this final thought. The U.S. government clearly views Intel as a strategic necessity, but as an investor, is paying a massive premium multiple for geopolitical strategic necessity really worth the risk of a business model that is currently burning billions of dollars in cash? Thanks for joining this explainer, and remember, always keep testing those assumptions